talk about the markets in 3 minutes. And Ven, your thoughts on the link between yields and stocks then? I guess, as we were saying, maybe it depends what is driving yields to go higher. How robust should that connection be right now, do you think?
Well, I think it's going to be working against stocks, acting like gravity on valuations, because, it's one thing to have a strong economy, higher yields. The stock market can withstand that because it means higher earnings. But in this environment where you've got tariffs, where you've got deficits under concern, you've got the threat of inflation and a stagnant economy, it's not going to bode very well for stocks, because you're going to essentially discount the present value of future earnings at a higher rate. That is going to pull down stocks, as I was saying. The problem with this recovery, Anna, that we have seen since early April, is that, investors are too optimistic. We have seen this movie play out before. And it doesn't end very well because, each time there's been a big crash in the markets, whether it's the great financial crisis or whether you go back to the dot-com crash, the markets always recover, or very enthusiastic to recover immediately after the drop. But that proves always like a warning shot for investors, and it doesn't work out very well. Now, if you look at the aggregate earnings per share on the S&P, last year it was about $240. So if you lop off even just a mild 5% of those earnings, and that's very legitimate because the tariff concerns and all that is dogging the US economy. So if you assume an earnings per share aggregate of $225 and assume even a liberal price to earnings of 20 times, you're talking about a valuation of 4,500. We are at 5,800. So there's plenty of way for the correction to go.
In terms of the data we're about to get, we're going to get PMI data. What are you anticipating there out of Europe?
Well, Guy, in the euro area, purchasing managers are going to report that, the economy did fine despite the uncertainty about tariffs. But what matters is, for the big picture, is that, look, the ECB, inflation is under control. The ECB is probably going to cut rates twice more in that cycle. What does that mean? It means that bonds are going to do well, and front-end German bonds are going to do well as well. Now, if you're a dollar-denominated investor, if your portfolio is denominated in dollars, you are actually getting paid to hedge the currency risk for your exposure to the euro. So the 3-month forward premium on the euro-dollar is about 70 basis points. Now, if you annualize that, you get about 240 basis points, which is a fantastic pickup over and above the nominal yield on bonds or front-end bonds. So that means that, even though the nominal yields are lower in Germany, they're much higher than what treasuries offer, after adjusting for the currency premium. And therefore, I think that those bonds are going to do well in the current months.